We're about to tell you exactly what you need to have to be in the top 10% of wealth holders in New Zealand. So strap yourself in, because we'll also give you the top 1% and maybe even the top 5% and maybe the top 50. Phil, Stats New Zealand recently updated their data around household net worth, and I going to be honest, I jumped on the Stats website. It came out on a Friday night, I believe.
Oh, you would have been there with a beer in hand and popcorn?
I couldn't believe it. I'm like, it's finally here.
0% of no doubt.
It's September 2025, and the data is from June 2024. We've only had to wait, 15 months to finally get hands on this data, because I used to put the data together based on an age bracket for people for Keep the Change of like, here's the median net worth per household and individual. And people were like, oh, that data's old. What it must be, I want it updated. So it's finally been updated, and now everybody's talking about it, which is good to see.
I like the fact that you reference it's recently been updated, but only to June 2024. And as you quite rightly say, some 15 months later, I believe the data is quite redundant, because what's happened to the economy since then?
A bit slow.
Very sluggish, and house prices in particular,
flat.
Buggered. Yeah, and I think for those that are in the top 50%, it would be fair to say that the family home represents the largest chunk of what contributes to their overall wealth. And from June 2024 to now, probably the value of that house has slipped back a bit. But at a household level, to be in the top 50%, your net position is just over $500,000.
At a household level.
And an individual, the difference, $134,000.
Yeah.
So it shows that the households are doing better than the individuals.
That would make a lot of sense.
Yeah.
If you combine the old household wealth.
The power of leveraging off of somebody else's contribution. Yeah.
I suppose an individual probably doesn't own a home, so then they wouldn't be having that level of wealth, whereas a household, it's probably a couple, and then the home plays into this. So net worth of people is assets minus liabilities. So what Phil's telling us here, to be in the top 50% of wealth holders in New Zealand for households, you must have assets minus liabilities of at least $524,788. I assume they take the middle point, right? So the median, and this is what they're going off. So to be in the top 50%, so therefore the median must be 524,788, and for an individual 134,850.
I believe that they break down the 1%, which we will get to, but I believe if we just look at households, that'll be the family home. So let's say it's $1 million plus your KiwiSaver, average balance $30-something thousand. Savings that everybody's got, none. After paying credit card debt, 10 grand.
That'll decrease your.
So that's going to decrease it. The mortgage on the $1 million home.
Yep.
That's got to be. Yeah. You know, so that to help people understand and illustrate. Oh, sharesies, you might have $5,000 in there.
Yeah.
Yeah. I don't know whether people are going to be self-reporting their Bitcoin.
No. Lost that in the boating accident, they reckon. I never know what they mean.
And one minus the other to get to, so the value of your assets, which is your house, your KiwiSaver, savings that you don't have, the sharesies, the Bitcoin that you don't declare, less those liabilities, which is your mortgages, your credit cards, your afterpay, whatever other things that you owe money on, is going to result in a net balance of $500,000.
Yeah.
I thought that was quite low.
For a household? Yeah.
Yeah. Yeah, my initial gut reaction, but then just taking time to step back and think about it, kind of makes sense, because at a household level in the top 50%, every time that we go through a boom cycle in property, people go, there's equity in there, and what do we do with the equity? We go and buy a new Ford Ranger.
Yeah, borrow against it, spend it.
Yeah, and then we get the toy, but then the toy will get old and we'll sell it, but we're left with the debt because we're going to pay the mortgage debt over 25, 30 years. Mm-hmm. The Ranger's going to last 5 years at best. I mean, come on, people, let's get real. Ford, if you want to get in touch, lnp@nextadvisory.nz. But yeah, it's not compounding or increasing at the rate that it would do when you start and get to the top 10%, I believe, because the 10% and even the top 5% have got a secret hack that I believe those in the top 50 don't have.
Shall I read that out, what that could be?
Mate, just lay it on us. Put it on thick, mate.
Well, it's basically not property, to keep it simple. So the wealthier in New Zealand don't invest their excess in property.
Yeah, I like that. Another way to put it is if you want to get rich in New Zealand, don't put your money in property. That's controversial for a lot of the psychology of your standard Kiwi who's been raised to go, I've got to buy the house. Well, it's traditional thinking, and I know that's been flipped on its head. Get married, have kids, buy a house, and then you get older, you realise that the kids aren't going to be able to afford a house, so we buy a rental to try and get them into that, and we jump on the bandwagon. Oh, Johnny down the road's bought his second one, so should I better buy my second and my third? And it's just this constant thing of property. But the top 10%, I can't recall from the article, but those people in those top brackets aren't investing in property to create their wealth.
Yeah, which doesn't surprise me because we live in this world and we understand the returns on investments and things like that, right?
So if it's not property, Luke, where is that wealth being created?
Horses. That's where wealth gets destroyed. Shares, pension funds, and James bonds.
Yes.
Financial assets.
Yes.
Yeah.
Or I would imagine businesses are going to be in here. The top 5%. So to illustrate, we go from 50% at 524,000 to be in the top 10% for a household. It's $2.4 million.
It seems like a considerable sum of money.
It does as a net worth, and I kind of thought, you start to put your comparison hat on and you go, oh, where do we sit? The top 5%, we jump to 3.7 million. The top 1%, when I read this, my mind then went to go, at 1% of a household, how many households are there in New Zealand? So therefore, 1% of those households, how many people is at that 8.7 million?
Yeah.
Just to put it into context, I've got what is that number? Are we talking hundreds or thousands of people that have got this net worth of at least $8.7 million?
Sheesh.
That's weak.
Weak?
Yeah, I would have thought it would have been higher for a top 1%er in this country. Given the MBR rich list, we must have to call bullshit on their numbers because Stats NZ have got real data, and who are we to question Stats NZ because they never go back and update the CPI data or the GDP data after it's released. Said nobody ever. But I'm surprised it's not over that.
Well, Brad Olson does point out, he said that people should not think that $11.5 million, which I'm not sure what they're referring to, but they're saying that that's the top of the wealth table in New Zealand.
Oh, that's the median.
Gotcha.
Yeah.
So there's quite a long tail. We've got some households worth over $1 billion, not many, but there is a long tail from 11.5 million out of there.
I think these numbers that we're referencing here are the entry points to get into that 1%. So to be considered in the top percent, your minimum is 8.7.
Yeah, gotcha.
The mid-range for a household is 11.5.
Wow.
So
the mid-range of the top 1%.
Yeah.
Gotcha.
So the top 50% of the 1% are going to have 11.5 million or more. So that's 0.5%. Then the other 0.5% are going to be between 8.7 million and 11.5.
Far out. It's quite, this data is probably quite well timed for some of the politicians to grab onto because, it just then jumps into something about we have a very unequal society in New Zealand and the distribution of wealth is causing huge challenges. Those who are able to accrue wealth are able to get even more of it in the future. And that, creates economic income, as they call it, isn't it? Like the growth of your asset values that you can't necessarily touch unless you can borrow against them. That's economic income versus earned income where you go out, do the work, pay the tax on it, and then you've got that income to do something with.
I was going to say, there's potentially a risk here, and we've touched on it before, like thinking small. But then I think our focus is too narrow in New Zealand in that we're so focused on property. But I'm really quite encouraged that there's a younger generational cohort of people coming through that are starting to educate and take themselves seriously, that are going, no, we're not jumping on the property bandwagon because we've seen what the boomers have done to the economy and the drain that they are on it with superannuation at being $25 billion a year out of the budget. What are some other ways that we can improve our wealth? And you can see the impact that Sharesies has had at providing access to the share market for these younger people that then go, I've got attachment to particular brands, Tesla, Nike, Apple, all of these offshore things, and go, right, I can feel a part of that. I'm going to put some money into it, and then go, oh, geez, that money on paper, like on property, can go up. And, shock, I can actually get a return on that by way of dividend, something a property can't do.
Oh, blasphemy.
Yeah.
Blasphemy. Yeah, we're having more exposure to financial assets because of the likes of KiwiSaver, the different fund providers, and then the platforms that are allowing us to do that. And this is very new, KiwiSaver is only really 20 years in. No, 20, is that right? 20, did it start in 2007, I think?
Oh, it was just over 20 years.
Yeah. Anyway, Sharesies, I don't even think they've had their 10th birthday. I think a Colonel the other day might be birthday number 6. And what this tells us, because I've been fascinated by money, early on in life, being a young fella that just liked math and numbers and shit. Then I read something like this, and I've learnt this stuff at an earlier age. The wealthiest 20% have more than twice as much in pension funds as the next 20%, and 8 times as much as the poorest 20%. The increase in property values between 2021 and 2024 was one of the factors cited by Stats NZ as driving the overall increase in household wealth through that period, but share markets have also performed strongly. A median household would have basically nothing in bonds, stocks, that sort of thing, but quintile 5, the top 20%, 18% of their assets are coming from stocks. The middle group of households had 92% of their wealth in their own home. Now, I've always been somebody who's pushing for more and who wants to be a 1% or a 5% and shit. And what I learned through my own professional development was, well, if you want to be like them, you've got to act like them.
Spot on.
So when everyone was like, property, you need to buy a house, hey, title, I'm like, whoa, but actually the data tells me this, so what can I learn from what they're doing? And this is where I think it's important for those of us who have gone down the property route to think about, okay, how can we change the wealth of the nation for maybe our kids and get them learning about shares at an earlier age, maybe investing for them and letting it compound, because the wealthy are basically laying out like, here's what we've done.
Yeah.
And that's the answer. But somebody said to me when I presented this data, doesn't it just mean that they've got more money so then they can buy shares? I look at that and I think, technically, I can see how you could think that, but that's like, then when do you ever give yourself permission that I've got enough to start investing in financial assets? People get rich because they invest into financial assets. They don't get rich and then do it.
They're prepared to make a sacrifice now for something better in the future. And I think too many, and it comes back a little bit to that tall poppy. And the interesting thing about this article, a couple of things is it highlights the disparity between certain groups and challenges the fairness and the inequality and then highlights this whole tall poppy thing rather than people looking at it and going, oh, why this and why that, rather than flipping it and going, well, as you said before, the rich have outlined how they've done it. So then going, well, how can I? And I think too many New Zealanders would then put in their excuses, oh, I can't do this because of this, or I can't do that. We've got all of the access now with platforms like Sharesies to be able to get into shares and bonds and other assets that were traditionally only the domain of the rich. You've just got to get started, and you've just got to start small.
Yes.
And I think if you do it like we talk in the context of business, being consistent in your application and regular with the stuff, you will see the compounding impacts of your change in wealth over a 5-year period. And if you're prepared to ride the ups and downs, you only need to look at the old benchmark S&P 500 index. I mean, it's got its downs in the short term, but over time, that thing skyrockets up. So if you're in long enough, happy days, you're banking gains. You're riding what the rich do.
Yeah, I recently went past $150,000 in my KiwiSaver.
Nice.
And because I track my balances of my assets monthly and teach people to do a monthly balance sheet effectively like we do in business and think, well, good enough for businesses, which are fucking financial assets as well, probably good enough individually, I can go back and I think, it doesn't feel like that long ago when I was thinking, shit, I've got 100K in my KiwiSaver. And I went back and had a look, and it's basically taken 15 months to go from 100 to 150.
Wow.
Now, I'm not saying I didn't put anything in and all of a sudden that it went, without me fucking doing anything, because that's what when I started talking about it on YouTube, it's like, oh, well, what was the gain, dickhead? It doesn't matter. I was still contributing and voluntarily contributing, but for me, I had the data to go back and see how quickly did I do this, but very loosely at a high level, about $23,000 of it, I didn't put in. It's market gains in that time.
Here's me sitting here thinking
That
it's
it's
gone
just-
from 100 to 150, but you have tipped in
Yeah.
75,000 and it's come back because it's, you know,
Yeah.
some
It's all in
top
on-
tip that you've got that hasn't come to fruition.
It's self-managed into a couple of banks, which I won't name. But what it highlights for me is, okay, it took me till 36 in my life to get to 100K. And Charlie Munger talks about, okay, you got to try and get a snowball to 100K, because once you do, it just starts compounding so quick that the numbers start becoming so meaningful that you go, shit. And that's exactly what's happened, where there's 20 grand of market gain in 15 months that I haven't had to do anything for. Then I'm like, whoa, 20 grand is a lot different from, 10 grand going to $12,000. And you think, oh, well, that's great, but my life doesn't feel too different. When it goes from 100 to 120, without you actually having to do anything for that 20, of course, I've continued to contribute. You're like, shit, like this is starting to become, this is interesting. I wonder how long it's going to take to get to 200, then to 400, then to 800, then to, and then all of a sudden I'm in the 1%, mate, talking about how everyone should be getting into financial assets.
Happy days.
Hope so.
And I think to put some business owner context on this, and it's a reminder to people that are in business and small and medium-sized business owners in New Zealand that your business is an asset and it's going to be included in this data. And you're going to want to improve the value of your asset, because at some point, something that's not often spoken about, rather, although Luke is an expert on the subject of succession planning, having recently spoken at a conference on the matter, that ultimately one day you're going to want to be out of your business and you're going to want to sell it. You're either going to sell it to some employees or you're going to put it on the market. That's when you're going to bank your return for the work that you have put in over the years and go, hey, look, I've started a business, started it with next to nothing, and now I want to be able to sell it for $1 million, $2 million, whatever the number you want to be able to sell it for. While you're still working in it, you need to treat it like an asset, like it's listed on the stock exchange, and go, right, what would a listed company be doing? What would be a top performing CEO be doing if they were working in this business to improve its value and its marketability on the market when somebody wants to ultimately come and buy it to then get some cash?
Yeah, I think as well, one thing that I'm sure you see a bit, but I hear, and you'd hear more of it being closer to the space, but people thinking, oh, my business couldn't be sold. There's nothing there to sell. I think there's this little bit of a lack of belief from Kiwi business owners that actually they're running something that could be sold.
Oh, yeah, without a doubt.
And they could be thinking about that 5 years in advance and going, okay, even if you start with that wrong belief, but then go, okay, someone plants a seed for you that, yeah, you could sell this, then you go on a journey of, okay, over the next 2, 3, 5 years, what do I do to make this more of a saleable business? And that's what your focus is, building up the asset value.
And I reckon the top hack for somebody that's looking at selling their business, going run day, and we're not saying in the next 2 to 3 years, but long-term planning. Put yourself in the shoes of somebody who's a potential buyer that's a professional investor. And as a professional investor, you've got a pot of cash and you're going to want to put it into something that's going to generate a return. And that return is cash back to you. So we're putting $1 million into something and we're going, okay, we want an 8 or a 10% return on this. It's got to be spitting out $80,000 to $100,000 a year, if my maths is correct. If that's your metric and you can achieve that, an 8 to 10% return on a business, if it's a passive investment, so if you've created a business that's self-managing and can consistently spit out 10% per annum to an investor on $1 million investment, sign me up.
I'm going to change tact a little bit, but one of the things that I think people will forget when they look at this data is it's very easy to look at headline numbers and then not think, oh, what does that actually mean? So one of the articles and what stats are leading with is they're saying New Zealand households are 33% richer than they were in 2021. So what they're saying is that the median net worth of households has reached $529,000 compared to $399,000 in June 2021. Well, none of these articles talk about asset inflation or inflation at all. What can your $529,000 buy you in 2024 or even 2025 compared to what it could buy you in 2021? I think that's just something for us to be mindful of as well, where it's like, oh, the rich are getting richer, yeah, but everyone's getting shafted by how expensive things are.
I reckon if we wandered down Queen Street or even what's that main street in Parnell?
Parnell Rice.
Parnell Rice, of course. And you ask the average punter on the street there, maybe Parnell's not a good thing, let's go to St. Luke's, the mall there, and say, look, are you feeling 33% wealthier than you were 3 years ago? I would bet a lot of money that most people would say no.
Yeah, not 1 and 2 would say yeah.
Yeah, no.
Yeah, I agree. I think
not at all. And then I think the other way to put it is that like this 500,000 number, if you said to, the other way for people to think about it is if you sold your house and all of your assets and we converted it to cash and then we paid everybody that we owe money to, so it'll be the bank and Afterpay and your credit cards, you're going to be left with just over $500,000 in your bank account. And I bet you the average person would look at that and think, that's not a lot of money. Like for all the effort that you put in, day out, at the job that you turn up to from 8 till 5, and the ups and downs of life and all of that, to only have $500,000 as a household, that's crazy.
Yeah, it is pretty scary, eh?
Like when you convert it back to cash, if we were to sell everything we've got, pay off our debt, you were left with $500,000 for all the effort that we're putting into. The 50% of people, it's only $500,000. It doesn't seem like a solid return.
Yeah, and then if you go, so median rent might be $600 for a shoebox-ish.
Yep.
So there's $30,000 for the year, and then you're probably going to need times that by, say, 3 for food, looking after the kids, etc. at a minimum. So let's just say $100,000. Well, you've got 5 years where you could live, and you're back to zero again.
Yeah, like 5 years before 50% of the country are broke. We're buggered because it really highlights on this how reliant our economy is on bricks and mortar assets inflating in price.
Yeah,
just to keep us going.
Yeah, it does, because I know like people get defensive about property because it's been such the thing to do, but just imagine where the country would be if we didn't shit the bed after the 1987 stock market crash and we kept investing in assets and we understood it, or even if we didn't just keep piling into property and you had 12 halters, you had 7 rocket labs, you know, you had 3 zeros.
Well, I would go back to 1987 and go, okay, well that's happened, but fast forward, let's bring the internet online in 1987. Let's bring Sharesies in at 1990.
Yeah.
Let's make KiwiSaver compulsory in 1980.
Imagine what would, like...
Where would we be now?
Fuck, we'd have some big sponsors for this, mate. Yeah.
Well, probably would, eh?
Yeah. The economy would just be completely different.
Humming, because I think people's mindset and attitude towards money and finance, we would have such a wider focus and appreciation of how wealth is generated rather than just the one-trick pony of property.
And I mean, I always beat up on it, so people are probably used to hearing me from talk about it now. But, you know, I was talking to a business owner today, and they had 3 rental properties. Yes, and now they have 1, and it helps subsidise the rent that they pay. And they have a business that's cash flowing, and they're getting going, and they're building, and they're investing into their education and learning early on. Most people wouldn't pay for coaching early. It's like, oh, I don't know if they've got money in the stock market. It's going well. And they said to me, honestly, man, when we had 3 rental properties, everyone was like, fuck, you guys are rich. And it's like, we never felt broker. You know, there's constantly an ovens going. This is going. It's like they are just money pits.
You're taking on the burden of other people's responsibilities and just shite.
And it's basically, right, 1 house and then rental and then wait for drift. Okay, another one. And I think, you know, we talked about this in the office recently, but I think younger people are coming through going, I need a bit more purpose in my life too. You know, and I'm not, like, if you want to do the rental property route, like, hey, fill your boots.
Just like, don't pick up the phone and call us when it turns to shit.
Each to their own. But younger people are coming through going, oh, I can see that path. That's a bit boring for me or a bit meaningless. I want to be doing, and you know, this guy today is a good example of it. Done it and then gone, this is boring. I want to be running a business, or I want to be doing something that I'm passionate about. And he's like, I want to be one of the best in my industry. So, you know, I think we'll see more of that. That's what I'm excited about with New Zealand, is that we've got this drift upwards of education and access to financial assets. My worry is that you've got this big group of people that are in this bottom quintile and even bottom 50% of wealth, and they are getting marketed to about consumerism, overspending, extra forms of credit, and those guys are winning that race. And people are signing up for different levels of debt, keeping themselves in debt traps and effectively poverty that they can't see, that they think, oh, well, it's just like it's in pastels and it's in great colours and it's easy and there's no fees, and don't realise they're committing their future income to staying poor. Well, I mean, that's what's happening. It's sad.
I did. It's true. It's true. All just to
Impress others and feel
exactly
great.
to put on this farce, if you will, of I am successful, but let's have a look at your balance sheet.
True story from today. I get a message from someone. They're sitting at the hairdresser. Someone comes and sits next to them, and they say, "Oh, before we start, I've come here because you guys accept Afterpay.
Oh,
Can we run it through first just to make sure that it goes through?"
actually,
True story.
oh man, get your ass out of the haircut salon, the hairdressing salon, and get some cash to be able to pay for it.
I could give you 10 more of these examples if you want them. But what I was going to say is the sad thing, mate, is it's never been easier to make more money. Like, it's never been easier.
Yeah.
If you said to your granddad, if I said to my granddad, mate, here's the tools that I have to make money in 2025, you show me the tools that you had, which one would say, oh shit, like who's got it easier to make some money?
Yeah.
We do. But people don't believe that. So instead they go, cheap credit, please. Oh, there's nothing wrong with this. Oh, it's just way of life now. Oh, and they just keep themselves stuck.
We've got, and people listen to that, insert excuse, we've got greater mobility and accessibility
The internet.
than any previous generation.
Oh.
100%.
And
And then people that will then say they don't have access to the internet have never been to a library.
oh, especially in Auckland one where they give you a gig every day, which I think you can run past the gig too, especially if you're not on any bad sites on your incognito.
Yeah. Oh.
Yeah, I read about it online.
Yeah. Okay.
I've got some stats at an individual net worth level that I thought people might be interested by age bracket, mate, because we know people love to
We love the
compare their
comparison
tackle.
data. How are we going to stack up?
So 15 to 24 have the lowest median, of course, because they're
Young.
new to life. $4,000.
Yeah. Wow.
25 to 34, $47,000. 35 to 44, $132,000. This is an individual, not a household.
Yeah.
45 to 54, it jumps quite a lot. $314,000.
That's a huge jump.
Yeah, it triples.
I've been through a number of property cycles. That'll be why.
Must be. Good point. 55 to 64, $488,000 is the median net worth. 65 to 74, $538,000.
Yep.
75 plus have their highest median at $590,000.
If I wasn't at the older end of that spectrum, I can see why people get nervous about retirement. Because you listen to those numbers and you're getting later in life and you're going, how am I going to survive? Because they're not big numbers.
Yeah. Like, for me, I think, okay, like I was speaking at a conference the other day and I said, hey, as you get older, you're going to have a high level of median net worth. They've got high levels of money tied up in term deposits. That's all they've learned about. As interest rates drop down, they're going to bring it into the market and going to spend it. What do you think that means? I wouldn't mind being a fucking travel agent,
Yeah.
because from 55 to 75, basically that's where all that wealth is because they've been alive to accumulate it longer, and they may want to spend it and start getting through it. So I think it's a reminder for a lot of us, if we potentially have older customers, like there is always a market in every industry that will have a lot of money. And we're currently seeing this with our clients who are targeting, or they can solve problems for cashed up older people. Just accepting quotes, yeah, no worries. Oh, let's go. You know. So,
and I think that point highlights this overall thing of us highlighting this data of, rather than like looking at the why is this happening in our society, of just going, well, flip the lens and going, how can I make this happen for my own self by taking better control and responsibility over the decisions that I'm making in terms of where I'm investing and getting ahead, thinking of your future self.
I'll read out some mean net worth, because the median is split in the middle, right?
Yep.
Half are above, half are below, and a mean is more an average, so it's the total divided by the total wealth divided by the total people, right? So 15 to 24 have the lowest median at 18,000. Remember the mean, the median was 4,000. So average or net mean at net worth 25 to 34, 136,000. 35 to 44 have 321,000. 45 to 54 have 647,000. 55 to 64 have 866,000. 65 to 74 have 954,000. And 75 plus at 864,000.
I listened to that and I was like, bring on the great wealth transfer, so that all of those 15 to 20, 30 something year olds will inherit that. sell it, we create more debt, and we go again.
Yeah. I think they'll put it into a different group of financial assets too, won't they? So it's going to be fascinating to play out. I think they reckon 1.5 trillion of net worth, 1.5 trillion to transfer down a generation from now to 2050. It's only 25 years. So again, the boomers have the wealth, but they're going to move it down over the next 25 years. If you plan on being in business for a long time, think about building up databases of younger people because they're going to inherit money. Yeah. They are going to take over the family business, etc. So, yeah, you can build wealth in two ways in this country where you can provide services. Well, there's many ways to build wealth, but what I'm saying here is you can go and do the work and provide services and then transact, pay your tax and then invest it yourself. But you can also build databases of eyeballs who are going to eventually be your future customer. And there are going to be some young people that are going to have a shit ton of money that they aren't going to know what to do with.
Yeah, spot on. Interesting data, interesting insights.
Always fascinating, mate. Shout out to Stats NZ, getting that data out nice and timely.
Yeah.
Yeah, I think it came out on a Friday night at about, I can't remember what time it was. It was
late. Were they burning the midnight oil up on Grays Ave?
No, I spotted it. It was the 26th. I'm pretty sure it was Friday. Was it a Thursday? Yeah. Oh, no, it was in the morning. I just didn't spot it until later on. Yeah, Friday. But cool to see some of that data and always fascinating, but be careful comparing yourself to others. Think about, like I aim to be like a 1%er in different areas of my life. I'm like, shit, I ain't in the net worth space. We've got some fucking work to do, So I'm like, what lessons can I learn from them if that's where I really want to be?